Okay, so let's have a conversation about cash savings for your business, because this is a very, very common question I get asked a lot, which is, Tess, how much cash savings should I have within my business? Do I need to save more or less than what I'm currently saving? Okay, now broadly speaking, there are many reasons why as a business owner you might decide to have cash savings within your business. One of those reasons might be that you want to actually be able to make investment decisions without necessarily having to wait on external funding. So you can just go into your cash savings, your cash reserves, and use that cash to invest when an opportunity comes. You also might decide that you might want to have enough cash reserves or cash savings in your business to basically prevent against any unforeseen circumstances. For instance, if you lose a major contract or a major client and the associated loss in revenues, how do you actually cope when that kind of situation arises in your business? So how much cash exactly should you have at any given point in time within your business? Let's start with a common suggestion of having a minimum of 3 to 6 months worth of cash saved up. Now, if you've not come across this term, this basically means that you are in a position where at any given point in time, you have at least 3 to 6 months worth of cash saved up that can cover your operational expenditure for the next 3 to 6 months, okay, in case anything were to happen to your business. And this will basically ensure that your business doesn't fail, okay? If you, for instance, lost a major source of revenue and you had enough amount of cash saved up in your business, then you're confident that for the next 3 to 6 months, you are able to cover the expenses of your business and keep that business afloat. So the truth is, whilst the suggestion might work for many business owners, it's not going to work for every single business owner that's out there. And there are a number of reasons why the 3 to 6 months rule doesn't necessarily work for every type of business owner. There are many factors to consider. Now, the first factor to consider is what stage is your business in and how do you get your money into your business, i.e. how do you get your revenue into your business? Now, because many startups or many new businesses will generally tend to have a negative cash flow anyway because of the associated high startup costs that they may or may not accumulate. However, as your business grows more and more and becomes more and more established, you might find that you need to have in place a higher level of cash in reserves to ensure that you can accurately, pay for any inventory that you need in order to support your business. Now, another thing I will flag up here is to consider just how frequently you are getting cash into your business, okay? If you are the kind of business owner where you have a relatively predictable, stable source of income that comes into the business on a monthly basis, then you may not need to have anything more than, say, 3 to maybe 4 months worth of cash reserve saved up in your business, compared to if you're the kind of business owner who has income that only comes in here and there, okay? So irregular sources or irregular patterns of cash coming into the business would signify that you might want to ensure that you have maybe even 6 to 7 months worth of cash saved up. So it might need to be a little bit longer compared to someone who has a very, very predictable source and pattern of income flowing into the business. And the second factor you want to consider here is whether there are specific points in time or within the year that you tend to particularly require a higher level of cash in order to purchase items for your business, okay? So for instance, depending on the type of business you're running, you might find that within particular seasons or within particular months of the year, you require more cash in order to be able to buy maybe inventory in bulk amounts, okay? This would signify that you might need to ensure that you have slightly higher cash savings for your business on top of your usual requirement for your operational expenses. So if this is you, if this is the kind of business that you run where maybe you are purchasing way more inventory than usual, say maybe around Christmas or around Valentine, then you want to make sure that you're stocked up just a little bit more in terms of your cash reserves, okay? Just to make sure that you are covered, just in case there is any unforeseen circumstances or unforeseen events that means that your income around that time suddenly drops, okay? So when you're thinking about how much cash you need in your business, you definitely want to be thinking about business growth. You know, where do you see your business within, say, the next 3 to 5 years? What are the plans you have for your business? If you are planning that you want to grow that business by quite a significant scale, then you definitely want to factor this into your cash reserves and into your forward planning for your business over the next, say, 5 to 10 years. It's way more easier for a business that has been slightly more established for them to build upon their cash reserves compared to a business that has literally just started. So compared to a startup, for instance. But it is definitely worthwhile putting that into your plan, because if you want to grow that business, then you will need to make sure that you are factoring in maybe some additional months worth of cash reserves just in case something were to happen, okay, to hedge against this happening. Now, your next consideration needs to be your cash flow trends. And ideally, what you want to do is you want to be looking at what your cash flow statement is saying, okay, and looking at trends that you are seeing within the figures, say at a minimum over the last 12 months, okay? Because for instance, if you have customers that pay you on the last day of the month, okay, but you have your bills, majority of your bills coming in, say, in the third week of the month, then you want to make sure that you are not basically going through your entire cash reserve before you've actually received payments from your customers. One thing you're going to want to pay attention to, particularly when looking at your cash flow statements, is you are going to want to look at what your accounts receivable looks like, okay? Particularly your accounts receivable days. How many days roughly on average does it take for your customers or your clients to pay you once they've been invoiced? And if you are finding that those days are way too long, so maybe you have on average 60 days, you want to make sure that you're implementing things that can help you reduce those days, okay? So you want to be able to get that income from your clients, from your customers much earlier than, you know, say the 60-day period, because the earlier you can get the income into your bank account, the earlier you can get the cash into your bank account, the easier it will be for you to maintain what we call a positive cash flow balance. So it's important to look at all these factors and specifically analyze how exactly this affects your business, because what you might find is that the common rule of thumb of having 3 to 6 months worth of saving might not necessarily apply to you, because there are many factors that will determine just how many months worth of cash you need to have within your business. For instance, the type of industry that you run your business within, you will need to factor this in, as well as whether or not your business is a startup or a more established company. It could also look significantly different depending on how much access you have to external sources of income. Now, a good place to start is going to be to look at your cash flow statement and to analyze that thoroughly. And if you decide that you are actually struggling to increase your business's cash flow position, then you want to make sure that you are taking steps to actively reduce or eliminate those areas where there are massive costs within your business, okay? And vice versa, you also want to make sure that you are taking steps to increase your sources of income, okay? One of which we've already spoken about is to try and look for ways that you can get cash quicker into your business. But another option will be to look at how you can create passive income sources within your business, because this can also prove very, very useful when it comes to helping you actually build a strong cash flow position. Bottom line is, every business needs to have a cash buffer it can access very easily. And a good sign of having strong financial management within your business involves you actually having very, very good financial reserves that you have built up over a considerable length of time. So it's worthwhile thinking about all the relevant factors that have been mentioned in this video and taking the steps to actually build your cash flow position to sustain your business in the long term.